All right, we have today Bhavik Vashi from Carta, who oversees the APAC the Middle East team. Thank you very much for joining us today on another episode of the Upside podcast. My name is Kristie, and I'm your host for today. And today, I think we understand that we have a new report that's coming up from Carta. I think it's the first report that you guys have for Asia and the Middle East. Maybe do you want to kind of start out with that, and then we can just let our conversation go on and talk about all things Middle East and Asia.
Yeah, thank you for having me. It's great to speak with you again, Kristie, from Singapore to the Middle East. So we're on a similar journey, I would say.
You're actually in Singapore now, and I'm in Dubai.
Yeah, we've switched places. Yeah, so it's great. It's great to reconnect. And yeah, like you said, we're coming out with our first APAC and Middle East data report. This is something that I've been with Carta for 2.5 years now, and since the day I started, pretty much people have been asking me for this. They said, "Hey, we love what Carta does in the U.S. This guy Peter Walker is on LinkedIn all the time, publishing all this amazing data. And can you do the same thing for the region?" And I said, "Look, I would love to do that, but the premise of us being able to do that is having a certain market share in the region, so that we have some data that we can then publish and then we can all discuss." And so it took us a little bit of time to basically have enough customers entrust us with their cap tables, to have enough funds choose us for fund administration. But now we're at that point where we feel like we have critical mass, enough of a sample size to put out our first ever APAC and MENA report. So hopefully this will be the first of many, and it'll become a recurring thing. But
Are you able to
I'm
share,
sure this first one will. Yeah, go ahead.
how big is the sample size for the report? It must have taken quite a while because, like the market in Asia and Middle East, I guess, are not as big. And when you go down to Middle East, it's even smaller, right? Because it's a newer market for you guys as well.
Exactly. And that's why I think, what I expect from this first report is a lot of like interesting discussion and dialogue around the few trends that we felt comfortable publishing. And then what I also expect is like an outpouring of, let's call them enhancement requests, or, "Hey, can you do this? Or can you also do this? Or can you double click on this or slice it by this?" And the short answer is, yes, we can, depending on, obviously what our sample sizes grow to. And so I think in this first report, you'll see things that are relatively summarized. We're able to break some stuff down by, for example, stage of growth. So we'll be able to compare pre-seed, seed, Series A, B, C companies, etc. We're able to break down a little bit between the regions as well. I think we have 1 or 2 comparisons where we're able to compare MENA versus Southeast Asia versus Australia, for example. But nowhere, near the level of sophistication that you sometimes see from Peter, where he's getting down to like fintech by state and stuff like that. Like if we were to do that, our sample sizes would get really small, like 5 or 10 or something like that, which probably isn't a trend so much as it is an observation. So we've had to keep our first report relatively, general and kind of broad strokes. But yeah, there's still a lot of interesting insights, particularly around like ESOP sizes, hiring trends, vesting schedules, things that are pretty much normalized across both the regions as well as the industries and even the growth stages.
Okay. So, now that you guys had completed the report, were there any particular areas in the report that kind of stood out to you or maybe kind of surprised you? You know,
Yeah.
yeah.
Yeah, totally. So the first one, like I said, we were able to look primarily at hiring and ESOP, right? And we purposely chose not to focus too much on fundraising because unlike the US, in this region, other companies can actually report on fundraising somewhat easily, like because of public registries and scraping and all that other stuff. Like that wasn't as, I think, niche or differentiated enough a product, but we felt like we were the only ones who had, a real insight into like the actual ESOP pools, the actual vesting schedules, the things that would only be present in like a cap table software versus a registry. Yeah, a lot of interesting insights. So I think I'll talk about a couple that come to mind. So one of them that we looked at is just looking at like hiring trends in general. And I'll make sure I get this right, but in general, people in APAC and MENA hire more at earlier stages of the company, which is kind of interesting. So, for example, if you look, and I'm just kind of pulling it up, but yeah, if you
Mm,
look at a US based company at a Series B, just to take an example, the median employee headcount is 30. If you take a Series B company in APAC and MENA, the median employee count is 53, almost double.
wow.
So that's kind of an interesting insight. Like startups in our part of the world especially again, I'm just picking Series B as a single data point,
Mm,
have almost double the number of employees.
mm,
I think and then whenever we publish this report, there's always like the next discussion of like why is that, or what do we take away from that? There's the obvious like okay, maybe labor is cheaper here. Where
mm,
is that? Where are those people located, right? If they were talking about 53 people in emerging countries versus 30 people in the U.S., you could understand like the payroll unit economics of an employee versus the fundraisers, which tend to be a little bit more similar in size and things of that nature. So I think it'll spark the conversation around why that is. But that
mm.
was an interesting insight for me. I didn't expect such a stark difference.
But I think this is also kind of looking back in the last couple of years where, obviously, I mean, coupled with, the amount of money that's been kind of poured into the ecosystem and this whole mentality around, grow, 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 build, 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 higher, 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 and obviously, in the last few years that has kind of like fallen off a cliff a little bit. And now I think what's going to be really interesting to watch, especially with AI, is how kind of startup business models and hiring trends are probably going to shift moving forward.
Yeah,
I don't even know if you guys did a separate survey on this because I know this is kind of like historical, right? The data
yeah,
is historical over the last few
yeah,
years, but this is already a conversation in the US, right? Like,
yeah,
can we see a one-man billion-dollar company moving forward? That's
yeah,
really crazy to think about. I don't know if in Asia, Asia, Middle East, if they've really caught on to that, but
yeah,
it'll be really interesting to see how those numbers are going to change.
yeah.
I would love to hear what you think about that.
Over the time series, exactly right. Like most of the time series stuff we looked at went back to 2019, because prior to
Mm,
that we weren't really present in the region.
mhm,
So it's just a matter of like when we've been here or had customers using us. To be fair, but you're right. Like if I remember the next chart in our report, right after we talk about like how many employees per stage, is we said, well, let's overlay that to a time series. And you're right, the hiring trend, and especially if you think of hiring as a ratio of departures, right?
departures.
Yeah, that has come down overnight. So if you look at like the 21, 22 years, it's between 10 and 11, the ratio of
Mm,
hiring to departures. That ratio has dropped down to 2 in
mm,
2024, which is pretty remarkable. So it's 2 new hires for every departure. So obviously that there's still overall ecosystem growth in terms of startup employees as a result of all across all startups. But you can see that hiring is much more focused and much more intentional on like where
mm,
do I really need a person versus where do I need a capability,
mm,
right? And how can
mm,
people be administrators of capabilities using AI and other technologies? And so
mm,
I think we're seeing that play out. I think that ratio is probably the best like leading indicator we have of that, which is, and if you even double click on that further, you'll see that the rate of departures has gone up significantly. I think
mhm,
it's more than 400%. Yeah, more than 400% in 2024, the growth rate of departures.
mm.
And the growth rate of new hires has just come down to just above 100%. So you're exactly right. Companies, I mean, the net of it is startups can operate and get more done, be more productive with less employees. That is true in this region as much as it is in the US.
But I think also if you kind of take a step back and you think about most of the, I'm just using Southeast Asia as a kind of point of reference, right? Like a lot of the venture-backed companies tend to be more kind of brick and mortar, or at least there's some sort of like offline element to it, right? Whether
Yeah,
it's like I don't know, clinics or cafes, like For Coffee they just listed recently, right? Like a lot of them
yeah,
still have a bit of that offline element to it, which still requires you to hire somebody to man the front desk and do some of these things, right?
yeah,
Compared to say in the US where perhaps you have a little bit of a wider range of companies that maybe and more SaaS led definitely
Hmm.
in the US, where you don't necessarily rely on, that brick and mortar aspect for you to require the kind of manpower needs that you need. So again, kind of interesting to think about like where the future of hiring could kind of go. I haven't seen or heard of any kind of like AI native business models coming out of like Southeast Asia, but I think that will be super interesting to see given that the kind of, supply chain manufacturing stuff that we have in Southeast Asia. Like, could we see something that's really interesting that Southeast Asia could produce something that's really kind of lean and super integrated, but, could grow
Yeah.
really quickly.
Yeah, and the other reality I think that I've experienced, I've been in the region almost for 10 years now across
Mm,
various roles, and but always in SaaS, just to kind of reference that point you brought up. And the service expectations in this region are notably different than the Americas. So
mm,
uh, all when you think about like SaaS, there's obviously there's a process of developing it, the process of selling it, and then the process of, as the name suggests, as a service, is constantly servicing your customers. And I think that selling and servicing part of SaaS has always required more people in Asia Pacific and MENA than it has in the Americas. I think because of both the nature of your customer being diverse across the region, speaking many different languages, being located physically in different places, coming from different cultural norms, expecting different levels of service or handholding relative to what they're paying you.
mm,
And then, just as a provider, being able to cater to all of those various needs,
mm.
you can't find those in a single person. Now you could find them in a single AI perhaps. And so I think like this whole like idea of administering agents will be interesting, but maybe I'm just jaded at this point, but it's hard to believe that a Southeast Asian customer, like even a MENA customer will say, oh yeah, I'm happy to be dealing, with some kind of agent. There's still a strong desire to get somebody on the phone or to be able to meet someone face to face and work through whatever part of the sales process or the implementation or the eventual like kind of delivery and an adoption curve wherever you are on that process. So yeah, that's an interesting reality, and we see that reflected again in our data, which was surprising to me because SaaS is supposed to be one of the leanest, highest gross margin
Yeah, I
business
saw that.
models.
There was one
Yeah,
chart, right? It's like SaaS is the highest when it comes to, was it
exactly.
hiring?
It was a early stage SaaS startup headcount. So I mean, you're looking very early stage, so pre-seed and seed. But again, the median headcount for a SaaS company at that stage is 10 versus like a consumer company is 5. That's
It's
interesting again,
crazy.
like
It's
double the amount of
double.
people in a SaaS company versus a consumer company. Um, but again, having led SaaS companies, being part of a growing SaaS company. I mean, Carta itself, since I joined, we had about 20 employees. Now we have 60 across the region. So I'm probably a proof point for why SaaS headcount proliferates, right? Very, very
Mm,
quickly. And this is why I can tell you being kind of in the business, this is why. Pair that with some of the, I guess, just the unit economics of the cost of labor, which is significantly different in this region versus your software revenues, which are marginally less, but not that much less. It's not
mm,
like SaaS is priced at 50% of what it is in the US. Let's say SaaS is priced at maybe 80% of what it is in the US, but then your labor, depending on how your blended labor cost is across different regions, could be as low as 50%. So there's an arbitrage there that allows you to have more people. And then if that is what your customer wants as well, then as a business leader, that's like an easy trade of saying, this is what makes customers happy. And it kind of works financially for me as well. So yeah, it's really interesting.
yeah. Oh, I mean, just going back to what you mentioned, I mean, like, yeah, again, you're talking about like double the amount of the median head count, right? Versus most of
Yeah,
the others. Like, if you look at number one, SaaS is like 10, and then
yeah,
the number two, it drops dramatically to like 6.5 for EdTech.
that's right. That's right.
So, I mean, I'm just wondering what really explains the massive difference between the two. I mean, apart from the reasons that you had already explained,
Yeah.
the time it takes to basically convert a sale, I guess takes, we still need to kind of put that face on, but does it really justify the nearly double of headcount that you really need for SaaS companies.
Yeah, I can't speak to whether it justifies double. I think that seems steep to me, especially given the stage. Because again, this particular measure that we looked at, we're looking at
Mm,
pre-seed and seed companies. So it's really what you're really saying is at a very early stage, you're deciding to grow your headcount faster or to a bigger number. I mean, all of these companies, if successful, will get to 10 employees eventually. But it's just that SaaS companies are getting there at pre-seed and seed
mm,
versus, and this one makes a lot more sense. But like a biotech pharma there's only two
mhm,
people because at that point they have nothing, right? They're probably just in research, right? And so
mhm.
they don't really need employees; they just need capital. Whereas
Right.
it feels like one of the core like accelerators for SaaS, according to the data and anecdotally, is just getting people on the
Mhm,
ground to again sell and service it. Because I think to develop SaaS is pretty easy
mhm.
relative. Again, let's just compare to a new drug in pharma. That like R&D is probably the easiest part.
Yeah.
It's product market fit, it's go to market, it's servicing those customers, it's having great net dollar retention, and then being able you raise your next round
Mm,
based on that early product market fit. And
mm,
so I think it looks like founders are over investing in getting product market fit through go to market to be able to then raise an A round in this case, whereas
mm.
you don't need that. That's not necessarily as necessary in health tech, biotech. And then consumer, hardware, fintech, ed tech are kind of all in the middle. Um,
Mm.
yeah, again, I think maybe just different growth, different expectations of how quickly you monetize and show product market fit.
I
That's
mean,
my best guess.
no, yeah, it makes sense. I mean, I think, yeah, I mean, keeping with that thought, I think also like the velocity of just kind of sales for SaaS is just so much faster. I think even on a
Yeah,
hiring point of view, right, it's just so much easier to hire for I don't know, like a fintech SaaS versus like as you say, like a biopharma or anything in a hardware space where, the
yeah,
kind of the talent pool shrinks dramatically, at least when it
yeah.
comes to hireable people in that particular niche or that particular space. So
That's right.
yeah. So I guess if they grow, I mean that the likelihood of them also kind of lay off people is also
Yeah,
probably higher
yeah.
for SaaS than it is for some of the others. So
Yeah,
yeah.
that's right. That's right. Yeah, and then the go to market is just different, obviously. But yeah, even at scale, right? If you get into um, any of those other industries, you generally can scale through partnerships, distributors, resellers, right? Like there's many paths to market.
Mm,
SaaS tries all of those, but having been in scaled SaaS companies, my previous company does over 1 billion in annual turnover now. So I've seen that scale as well. And partnerships are great, but they're never the essential ingredient of distribution and go to market scale. There's always this like very heavy direct motion.
mm.
I'm sure somebody will disrupt that in a pretty meaningful way, but as of now, like that just doesn't seem to scale as well in SaaS.
This is a slightly different kind of off-tangent question, but just because you used to work in the US versus kind of
Yeah,
Asia,
yeah.
how would you compare kind of the sales conversion cycle and speed to conversion in the US versus here? I mean, how much slower is it here in Asia? Like, what were some of the hurdles that you think you've had to kind of cross that maybe you didn't really have to cross when you were in the US?
It really depends. I mean, and again, I can only really speak to SaaS with experience. So now this is kind of like turning into a bit of a SaaS deep dive, which is fine. I love SaaS, but uh, it really depends on your segment. So, like SMB, mid market, enterprise, traditionally the three segments that any SaaS company will kind of think about their market opportunity. Super different. SMB, for example, and even mid market, I think is the market opportunity is similar, comparable for the purposes of your being a startup, I would say. So there, it's really about execution, and the execution challenges in APAC are just a lot more localized, frankly, and also you're dealing with, broadly speaking, less mature or experienced buyers of
Mm,
SaaS, right? In the US, if you go to market with a new SMB mid market product, it's all English. They're in the States. You kind of understand each other. Like a bunch of stuff is solved. The regulatory environment's the same. Like everything is easy in that sense. And then when you meet the customer, again, how you meet them, whether it was through an email, a phone call, an event, uh, the general, I would say this is probably a cultural thing, but like the receptiveness to have a conversation, hear the pitch, understand the value proposition is, I would say, default higher. I think here people are guarded. Like, are you selling me something? Like, what's happening right now, right? And so, and even once you get past that, it's then if they get to awareness and evaluation phase, they've done this before. You're generally not going to be the first piece of software they've ever bought, and so they kind of understand the questions to ask, the way to even navigate that buying cycle, if they need to do infosec, IT security reviews, if they want to test on certain feature functionalities. They just know the questions to ask. They know how to go through that process. Whereas, again, here in the region, and it's changing rapidly, but still, I think often you might be the first time they're buying software in the specific industry function target use case that you're selling. And so your competition is doing nothing online, right? It's some manual process. Even for Carta, I mean, today we sell cap tables and fund administration. Our number one competitor is not any other software company or service company. It's people and Excel and email and PowerPoint. Like that is status quo is the competition. And that getting through the inertia of adopting software, whether it's Carta or something else, that in itself is going to take you longer. You're doing a lot more education here first before you earn the right to then solve the problem. You kind of have to educate them on the problem, implicate the pain of that problem, help them realize it, and then say, okay, and then pick my solution versus another solution. So it's just a longer process in my experience.
All right. Okay, we can talk a little bit about Carta's expansion and business later, but let's complete our portion of the report. So I think there were other parts of the report that you guys also covered. I think one of them was also ESOPs.
Yes.
I believe there was a graph that was kind of comparing ESOP practices or like ESOP pools for MENA and ME and Asia versus the US. Any interesting things that stood out for you or that kind of surprised you from
Yeah,
the
so it's
data
funny to
point?
look at them together. Like you say, APAC and MENA, they hire more people. But I think what's implicit in our report is they seem to value ESOP less, or people give ESOP less, or chicken and the egg, or circular reference. Like not exactly sure, which one starts which, right? But the net result is ESOP pools just flatline, pretty much, which is really interesting and completely the opposite of the US, right? So normally what you'll see in the US is you'll have like a very, very small ESOP pool, and then around your seed stage is when you'll have to set up an ESOP pool. Your lead investor for your seed round will basically ask you pre-seed, you're doing safe notes, angels, etc. It doesn't really matter. And then at your seed round, when you have a priced round, which is kind of how we define seed, it's like, hey, set up an ESOP pool. We want your employees to be super motivated, sharing in the upside of this company. And so the median ESOP pool for startups, even at a seed stage, is 14%. Just again, that's 14% of your company is reserved for employees, basically. And then that steadily grows with every subsequent fundraising round. So it'll go from 14 to 15 to 17, all the way up to, we see about a median of 18% at Series C+. So almost like a fifth of your company, I'm rounding a little bit, but almost a fifth of your company, 20%, is going to be reserved for the employee stock option pool. Compare that to APAC. We see that same dynamic happening at seed, where it's like, hey, set aside some ESOP, but the median versus 14 is just 11. And anecdotally, I can tell you the common advice people give here is 10. People like 10%, set 10% for ESOP. And the interesting thing is from seed to Series C, it doesn't grow very much. So it pretty much in our data goes from 11 to 12 over 4 pretty meaningful fundraising rounds, right? And that's just really, really interesting and really different, because normally when you raise capital, external capital, in addition to obviously diluting yourself, and you're trying to hire a bunch more people, generally speaking, like you're trying to fuel the growth of the company. And often headcount is a key part of that. It might be strategic headcount. It might just be scaling headcount. And those usually you have to set aside a bigger ESOP pool to now be able to give those new hires the appropriate level of upside and financial gain and alignment with the company over the long term, as including senior executives, right? Once you get to a Series A, B, C, you're usually trying to bring in some VP level people, maybe your first C-suite comes in and they expect, sometimes up to as high as like a percentage point, depending on how senior of a big hitter you're trying to bring in. And so it's really interesting to see that that's, at least from a data perspective, not necessarily playing out in APAC and MENA. And it begs the question, do founders and investors to some degree, but really founders not want to give equity? And do they like to retain that equity for themselves, which is ultimately the trade-off? Because investors, you have to give them their cut through fundraising. Or is it that employees don't value that very much, and therefore there's no need to increase the ESOP pool because nobody's asking for it? They all prefer cash anyways. Or a combination of those two things, and how are those linked? And ultimately, I think it ties back to something we see all the time, which is I think employees don't value it nearly as much as in the US because of the lack of liquidity on an ongoing basis, and then the lack of exits, which that's your ultimate signal for what this could eventually be worth. And if you don't have confidence that the company, these paper things, will be worth something someday, you're not going to value ESOP. But yeah, we see it in the data, which is really interesting.
Yeah. I guess, quite a few things to kind of follow up on that. Like, if you think about like emerging markets, whether you're, employee number 2, 3 in Indonesia or Vietnam, and you're kind of, you're struggling to get by, and you still need to put, food on the table, cash is still king, as you say, like in some of these places where, and again, and as you say, there hasn't been a lot of track record in terms of people who've been able to successfully cash out their stock, quickly enough. Secondaries is still relatively new in Southeast Asia. Forget about Middle East. I think that's still very, very early conversations here. Makes it difficult, I guess, for employees to really see the value of stock, right? It's like, when am I going to cash this out? We've got fund managers who can't even, are struggling to even get secondaries. Like, forget about, employees getting real cash. Yeah.
Totally. And it's, this one, we could have a whole separate episode just on this dynamic, because I do think this is in many ways the root of like the venture capital thesis in emerging markets and in MENA. Because, okay, what does that imply, right? If you just double click on it, it's like, okay, employees prefer cash. How is a startup then, if we assume employees prefer cash, how is a startup ever to compete with a Google or a Facebook or an Amazon from a cash compensation perspective? It can't. Just full stop can't. And so then if you think about talent and the natural, the Darwinism of talent, so to speak, top talent will go to where they can be, remunerated at a top tier, which if it's only cash and all things are equal cash, they will all flock to working for, broadly speaking, MNCs or large established local companies who still, by the way, struggle to compete with MNCs because MNCs will give you the cash comp and a equity in the public form, right? Which is liquid and can be realized. And so then if you just keep pulling the thread through, it implies that the talent at startups is of a different caliber or a different mindset than the talent that's going to those companies. Not to say, worse, and I was careful not to say worse, but just different. And so that then is a feedback loop almost to, well, what's going to drive the success of your company? Ultimately, it's exceptional people coming together around a problem or a purpose or whatever that you want to work on, but you do need extraordinary people, despite how much AI we have. Like, people are going to make that happen. And so now you've got a little bit of a loop where you're like, whereas again, if you look at the US, the whole cycle is different. You graduate from a good school or, with a lot of even industry skills and experience, like a lot of people are excited and specific about wanting to work at a startup and being part of building something, and then obviously benefiting from that through an exit or even some kind of secondary liquidity thing. So it is this kind of vicious cycle that needs to be broken somehow. And it's interesting. One of the other things we see in our report, just to go back to that, is although somewhat marginal or subtle, there are differences across the region. So whereas like if you look at Southeast Asia and MENA, it's about 10%, right? The ESOP pool, as I mentioned. If you look at Australia, it's 12.5%. And what does Australia have that we don't? They have Canva, they have Atlassian, they have Xero, they have like a handful of companies that have basically proven this and recycled the capital back into venture through the Air Trees and Square Pegs and Blackbirds and all those folks down there, but also recycled that talent back through the ecosystem as well, through advisory, angel, operating partner roles, or even going back into starting startups. And so, in a way, it's been kind of proven out through one cycle. Now, you could argue that it's starting to happen, and especially in Southeast Asia, right? Like we've had our early successes where you've seen the recycling of that talent, but yeah, that is one of the kind of fundamental unlocks, I think. And I do think, to your point, secondaries is a um, undervalued, underutilized piece of that puzzle
Yeah.
that that could make sense for lots of different participants. I think that needs to be structured. I think it needs to be like company led, company sponsored, whether it's doing a secondary off the back of a primary,
Mhm.
oversubscribing it, giving some employees some liquidity, or just a buyback, or anything structured like that. But I think it's so critical that more companies do that just to break this
No,
vicious cycle around
100%.
the talent side. Yeah, like it's almost like a social thing that needs to be done.
Yeah.
And so
I
obviously we
actually
promote
think,
that from our side, but yeah, we would love to see that happen.
yeah, I feel like secondaries is one of the biggest opportunities that the emerging markets actually really need. And I
Yeah.
don't see anyone kind of like really attempting to solve this problem because if we really want, as you say, right, like if you want emerging markets to kind of break out of that cycle, we need more liquidity in the ecosystem.
That's right.
Unfortunately, you're not going to see that from IPOs or M&As at least.
Yeah.
Sad to say.
I'm a little bit more optimistic about M&A. Little bit more
Okay.
optimistic about M&A. Exits, yeah, that's a whole different question around scale and also ultimately the ability for
It's a
even public
liquidity issue.
markets.
Yeah.
Yeah, yeah, yeah.
Yeah,
Correct.
it's a liquidity issue. So and nowadays, there are ways that we can structure it. I think, yeah, I think really comes down to, I guess, the leadership if they're willing to kind of structure something. And it needs multiple players to work, right? Because if you need a buyer, you need a seller. Someone needs to kind of crack this problem because, I think, yeah, if you really want that, we need more liquidity in the ecosystem so that, you kind of get this virtuous cycle kind of going. The other thing that I
Yeah.
was thinking about as you were mentioning about the point that you raised is the dilution of ESOPs, like okay, 10%, it kind of flat lines in Southeast Asia, MENA. I mean, just based off my experience, especially for a lot of the early kind of founders from Southeast Asia, is that over time, a lot of the first batch of like founders in Southeast Asia, they actually found themselves over diluted over time. And
Mhm.
sometimes I wonder, like, could it be, kind of inexperience on the part of a lot of these early founders? A lot of them were first-time founders. They've never done this before.
Yeah.
And so they never kind of thought like, and okay, if you take us back to the time where there was a lot of money that was kind of entering the ecosystem at that time, and then, a few years later they find out, oh crap, I'm only like 6%.
Yeah. Yeah. Yeah.
So there was no like real, I guess, push or, driving factor motivation on the part of the founder to say like no to the investors, like you are taking too much of my equity. I want to
Yeah.
preserve this pool for me and my early shareholders, right? So
Employees. Yeah.
yeah, so I think it's kind of sad if you think about it because, the moment you're below 10%, you're essentially just an employee. I mean,
Yeah.
your investors are the ones who are kind of running the show now. You've got a whole bunch of these. Some of
Yeah.
them are unicorns in Southeast
Yeah.
Asia. I don't not so sure about Middle East, but I wouldn't be
Yeah.
surprised if some of them find themselves in this spot
Yeah.
eventually. But yeah, it takes the
Yeah.
founder to kind of like draw the line in the sand.
Yeah. Totally. And it's one of these. This is where free market capitalism works best, right? Because
Mhm.
if you think about it, even the investors don't want that, right? Like you think like, oh, these like I'm not saying, maybe you didn't say it, but some people say like, oh, investors are a little bit predatory, right? Like they know that this is, they're sad, so they're gonna go get more of the company. But
Mhm.
investors don't really want that because investors aren't gonna wake up every day and run the company. They want the founder to do that, and they want the executive team to do that, and the employees to do that. So investors are also the people who push for ESOP pools to be bigger, generally speaking. Like it's usually the investor saying, hey, make sure you have enough in your ESOP pool to go hire great people and to motivate great people. And like you said, the founders are included in the common, right? The common shares. And so fundamentally think of them like ESOP plus founder, right? And so there is this like this perfect balance that you have to figure out. And we see a little bit of that in the data. I think when we looked at dilution, so ESOP pool is, very specific to the employees, but you can look at overall dilution in terms of how much of the company are you giving away at each fundraising round. And we saw in our data that especially at Series A, APAC and MENA companies give away a bit less than the US does. And maybe that's a reaction to what you observe, because you've been here for a while, right? And our data is really starting in 2019. And so what we might be seeing in that, especially over the last couple of years in the Series A, is that reaction from the founder to be like, you know what? Okay, hold on. I'm going to give away 18% of the company instead of 21% of the company in Series A. And that 3 percentage points is a lot of employees, by the way. Like that could be 6 to 8 senior leader hires on those percentage points, right? And so, it's really interesting because, APAC companies, like I said, and median are giving away less of the company at seed by like 0.7%, Series A by a whole almost 3%, Series B by another percentage point. And it's only until Series C where the amount of the company that you're giving away starts to normalize between US and MENA. And that's interesting because obviously at Series C, your percentage likelihood of an outcome are exponentially higher. Like there is likely going to be an outcome. It may not be the best outcome, but there will be an outcome. It's unlikely the company will just go to zero, shut down, and be worth nothing. Now it's just, are you going to be able to return capital to your investors and have some money left over for the founder and the employees? And so figuring out that balance of scale and what's the exit going to be? Is it going to be M&A? Is it going to be public listing? That's more the question at that round. So it's a very, very interesting dynamic. But I think my tenet is like you always want to have 10% of something versus 100% of nothing. Like that has to be the guiding principle, right? And so there's obviously nuance to it, but at the highest level, you got to do whatever you need in your company's context to scale it and have it be worth something.
Yeah. Maybe a big picture in terms of like where markets are going these days, especially for Southeast Asia and Middle East. Where do you see, it's been a few years that you've been in Asia, and then more recently you've also entered Middle East. Where do you kind of see us in a market cycle right now? What does it mean for Carta, especially since you guys are, very rapidly expanding in the region?
Yeah. Yeah. I mean, I'll separate those as well, just, for the purpose of the clarity. I think our expansion in this region is somewhat decoupled from the macro. And what I mean by that, it doesn't mean that they aren't like related, but I just mean that let's say the TAM for us was 1 billion. Even when the market contracts and we go through difficult cycles and the TAM becomes 750 million or 500 million, you can put whatever discount factor you want. It's still a market worth pursuing, right? Especially if your basis is 0 or 5 or 10 or something of that nature. And so from a expansion perspective, luckily, to some degree, we're pretty insulated from the macro, and that as long as there is a market to go after, we'll position ourselves for it. And in fact, we're in a position of strength as a scaled company globally with a strong balance sheet and strong economics that we can be greedy when others are fearful. So if everybody is running away scared that emerging Southeast Asia is not what it promised to be, and this, that, and the other, we can play the long game and say, well, but there's still a market here. I mean, maybe it's not the $2 billion market, it's a $1 billion market or whatever, but that's still a market worth going after. And so in many ways, I think that's been helpful to us. It's weeded out a lot of opportunistic competition and only left the players who are really here for the long game, who want to be a part of the ecosystem long term and can afford to ride it out together and hopefully change the outcome itself. So that's on the Carta side. On the ecosystem side, I think, look, this as well as I do, in Singapore, and I forget who it was. There was a pretty good report that came out recently. Was it Lightspeed? I think that was kind of like revisiting the Southeast Asia promise, right? Yeah.
Very good report. Yeah.
Very good report. And I thought they pretty much hit the ball on the head when they said, you know what, look, is not exactly the market we thought it was, but there's still a great market here. It's just going to look different. They're going to have more, and I know these are, I should come up with some more localized terminologies, but I think people broadly understand like singles and doubles versus home runs. This concept, some people, my friend Jeremy at Tinman, he always calls it zebras instead of unicorns. Some people will say, you know, VC here looks a little bit more like PE in other regions where, you know, you're taking a little bit more of a hands-on approach. You actually hope for not power law in terms of 1 or 2 outcomes, but you need to get 4 or 5 outcomes. And then you get into these really interesting debates around what is the right portfolio construction strategy in Southeast Asia versus in the US. Because in the US, you could have a power law. I just need one company that goes gangbusters and lists, you know, and hits a market cap of 10 billion, and it covers the other 19, 20, 30 that didn't work out, right? Like that, the math works at a certain scale of a fund. I think some of the recent funds that Lightspeed and Andreessen have raised into question, like, oh, but this fund suggests you're going to produce 7 unicorns. Like, how is that going to happen? And so,
You know, it's funny you say that because when I look at the Middle East, I see some of these funds are so massive, and I'm like,
yeah,
you know, and you compare like Middle East to Southeast Asia, you know, you're actually talking about a significantly smaller TAM.
that's right.
And you look at the AUMs that some of them have accumulated till it's just kind of like, I'm wondering like, are you going to
Yeah.
see another replay of what happened in Southeast Asia? I hope not.
Yeah.
But yeah.
Well, I think the one thing I see in MENA investors not is generally there is a more globalized point of view.
Mm,
And a more globalized remit as well. Even the
mm,
investors who might have to take a certain remit based on the so you know this stuff kind of trickles down. So if you're a
yeah.
fund, it depends who your LP is. Your LP may put some strings on their capital about where that capital should ultimately end up in what kind of companies and regionally what kind of countries it should be benefiting ultimately, right? But even within those, there's always room. So maybe it has to be, for example, 70% back to Saudi, but 30% is really just returns based. And so
Yeah.
everybody's got this ability to do a mixed strategy of like investing in regional businesses, but also investing in global businesses that are just expanding in MENA as a new region or vice versa. And like you talked about, now there's this new corridor between ME and Southeast Asia where you could think about conceptually replicating a business model, a service offering, a product, and trying to extend it so you increase the market opportunity itself. You're right. And so admittedly very, very hard. The easier thing to do would be to just build for the US and like be able to scale the IPO just in the US. We have a few countries like that. We obviously have China. You know, we obviously have, and then we have these groupings that people like to put in the same bucket. We'll say, oh, if you combine all of Southeast Asia, the market is actually almost as big, right? And if you combine all the GCC, but we know that in execution, that is a lot more difficult. I
Yeah.
do see, I do think the GCC seems to be a little bit more progressive, or maybe they've just taken lessons learned from Southeast Asia to try to enable that at the policy level, right?
In terms of,
I think in terms of promoting companies to expand, let's call it pan GCC, and not say, you know, hey, we only want the UAE companies to win, but we don't, you know, like it's a competitive thing versus, you know, Bahrain versus Qatar versus UAE. Saudi and UAE, I could argue there's like a little bit of like a healthy competition going on. But I also think they focus in very different ways. Like the Saudi companies are predominantly focused on consumer problems because they have this domestic market to go test and learn and at least get to their first couple rounds in, and then they can export. Whereas the UAE seems to be taking a more of like a regional hub approach, a la Singapore, where you could build a B2B company, you could build obviously a crypto company, Web3 company, things that export far beyond the borders of the country that you're building in. It's just a great place to build and a good environment to live. And so it feels like they're trying to find their this natural like difference in what the two countries are going to compete for.
yeah.
And I think that some of that is lessons learned from Southeast Asia, where at one point you'll remember everybody was in this race, right? I mean, some people were
Yeah.
winning and some people were losing, like Malaysia versus Singapore versus Indonesia versus Vietnam and Philippines, and like everybody was going to try to be they hadn't all figured out these like mutual lanes to go pursue. I think they are now in 2.0 or 3.0, whatever you want to call it. Everyone's kind of figuring out their niche and how they're going to
Mm.
play, but it took us a 10 year cycle, I think, to get there.
Yeah. I mean, being here for the last couple of months, I think it's been interesting to also kind of draw the comparisons that I've seen between UAE and Singapore. You come here and everyone is kind of like, oh, UAE is like Singapore, right? And I'm like, yeah, but not really. Like, I can see like some things that they've borrowed, but at the same time, as you say, I think they've also been able to kind of localize a lot of these like top line principles that they've taken and
Yeah.
to make it kind of relevant to their local markets. And I think the kind of edge sometimes that UAE really has vis-a-vis Singapore is that because you have such a massive like expat population, it's like 90%
Yeah.
of the roughly 10 million people that you have here. So you're not really kind of, I mean, for better or worse, kind of answerable to some of the local needs. Like, Singapore, I guess it's always kind of front and center, right? Like, how are we enabling, more jobs, job creation for Singaporeans, better welfare, better this, better that. So everything has to kind of tie back to what can Singaporeans benefit for the Singaporean economy, so on and so forth.
Yeah.
Here, though, it's the other way around, and so in so many ways, like the dynamics and the kind of motivation factors that influences the decision making on a very high GTG level, it's just so different, right? It's almost like a free for all. It's like, okay, just come and set up shop. It's like if it doesn't work out, okay, fine, you'll just cut it and start from the ground up all over again, which is just kind of very bizarre to some people. But I guess this
Yeah.
is just kind of the way that they can go about doing this because they can, This is
Yeah.
kind of the slight edge that I think that UAE has over Singapore. I think Singapore's great, but yeah, it's just very different ways of,
Yeah.
approaching things.
And they're the foundational economy
Mm,
upon which it's built, and therefore the policies are built, is different, right? I
mm,
mean, UAE and Saudi have natural resources that Singapore could only dream of, and
mhm,
that backstops a lot of this, right? So
mhm,
UAE's desire, and Saudi's desire, and many countries in the GCC's desire to diversify their economies is is really like a proactive and strategic and front-footed approach, which is great. Whereas I think Singapore's desire to be this very diverse and inclusive, but as you said, like now running into certain protectionist considerations as well, comes out of necessity, right? Like
mhm,
if not this, then what, right?
mhm.
It was only strategic port location, right? And that I think is like the one key advantage Singapore had, like coming in, and then just like how do you parlay that into the next thing, into the next thing, into the next thing. So that was it was much different. I feel like Singapore in many ways is like an underdog that has made it, and now is kind of how do we continue to compete versus the UAE and Saudi, because of obviously a lot of the discovery of oil really started it. They were able to start from a position of strength and be then proactive and say, okay guys, this won't last forever, right? Let's get ahead of this, let's diversify the economy, let's invest in these massive initiatives, let's do all of this other stuff. But fundamentally, they're not yet at a position where they have to. They know they will need to, but they're getting ahead of it, which is really smart. And so I just think that like that difference is also true in what you see manifesting even at like the startup and venture layer. Because again, a lot more of MENA's VC ecosystem ultimately
Mm.
is being fueled by sovereign wealth more so than it was true in Singapore.
Yeah,
Singapore did the same, but not the scales are very, very different.
yeah, yeah.
And that's a big difference, frankly.
No, 100%. Yeah.
Yeah,
Maybe just last question before we wrap up.
sure.
Yeah, I mean, for Carta, any things that we should be looking out for the rest of the year? What are you guys busy with? Yeah, just a look ahead for 2025. I think one quarter has passed, but
Yeah,
I'm sure there's a lot on the table for you guys.
yeah. No, it's like I said earlier. We're in a very fortunate position to be somewhat decoupled from the macro. I mean, look, at the beginning of this year, I was on record across multiple like media outlets for saying that I think this is going to be actually a good year. I thought there was a great opportunity for public market revival, even in the region. That we're going to see some notable exits. I think we still will, but we'll see some notable exits in MENA, GCC, in Southeast Asia, specifically in Hong Kong and India. But obviously, things have changed a little bit. There's a lot more uncertainty today than there was even a few months ago when I gave those interviews, and with tariffs and just the impact on the global economy. All that being said, we're in a very fortunate position to be somewhat decoupled from that, as I said, just because it's affecting the TAM, but not really what we're doing on a day-to-day or a week-to-week basis. So we continue to be extremely aggressive and frankly bullish about setting up the infrastructure layer here in the region from a private markets perspective, so that whenever the next real bull cycle comes, it will be heavily administered and operated through Carta, whether it's on the cap table side at the founder and company level, with equity being distributed to employees and investors, and fundraising rounds being raised and closed, and compensation being given out to employees, and all the other things that we help founders with, to the next level, which is really where I've spent a lot of time focusing, is on the fund level, and thinking about how is a fund actually administered and operated. Like, how does real-time accounting and visibility work for a fund in private markets where all the assets are private, illiquid, opaque? How can we bring transparency, clarity, consistency to that, and pull that all the way up through to the LP layer, where now LPs also can understand their underlying exposure to various different companies and asset classes. And that's what all the LPs are asking for, is they want accountability, right? When they invest in public markets, you have daily accountability from your investments, so to speak. And you can know they're going up and down, and what's happening and why. In private markets, it's like, I'll see it in 10 to 15 years, right? And I don't think that's going to work anymore. That's our fundamental thesis. That value proposition, that trade doesn't work as much anymore. So how can you bring more transparency, more visibility to that? It's a really complex problem because it's completely unstructured. The regulation is different across every jurisdiction globally, which is something we touch. There's no consistency in reporting standards. It's really hard to pull all that data up and through into one place and normalize it. You have governments in Singapore and Hong Kong that are both thinking about expanding, private market funds to retail, and so that's not really possible unless you have great data to be able to make those decisions on, like, should I buy or sell this VC fund, if that can happen in the future. And so I think we're well positioned to solve all of those problems. And like I said, we're going at it from these two lenses, making founders extremely successful and really emphasizing corporate governance. I think we've seen the need for that recently in Southeast Asia as well. So really making sure that companies are passing audits, the cap table is 100% clean, like all of that. We also help with board consents, et cetera. And then making sure we're doing that at the fund level as well. Same set of problems, different, level of the ecosystem. And then, horizontally looking across the regions, because VC and private equity is not specific to a country. In fact, it's incredibly interconnected, especially when you get to the LP layer. So we are solving that problem in Singapore. We've expanded to Australia with our office in Sydney. We've expanded to MENA with our office in Abu Dhabi. We're looking at the Hong Kong market actively. And I think that, at least to start, would position us across most of the major financial centers and economies that we would need to play in. And then we'll continue to be pretty aggressive and bold in terms of where we want to go next. It's exciting times for us. We're growing, we're enjoying it, and we're learning a lot. And we're also finding that we are now becoming even more useful to the ecosystem, because now when I come in and meet one ecosystem's associations, industries, and even government officials, we actually have a point of view on how everyone else is doing it, because we're working with them all. We're on Capitol Hill in the US. We've got our offices in London and Lux, and I've got Abu Dhabi, Sydney, Singapore. So we can actually start to see pattern recognition, things that are working, things that aren't working, and so we become more useful as a result to the ecosystem as well, which is definitely something we want to do.
Cool. All right. I think we've come to the end of the podcast, but thank you so much for joining me today. Hope to see you soon. And
thank you.
Thank you for joining us.
Thank you for having me, Kristie. Always a pleasure.